Alright, so I wanted to give a video update on Chime. They reported earnings yesterday and I was anticipating this because the stock looked interesting and this was their first public quarter. They were a little bit down on the pre-market despite a big raise in revenue guidance, and this brings me to my point about my whole kind of sentiment on Chime. I think they're still very under the radar at the moment. It's interesting because they surged on IPO. The market sort of lost interest. Amongst the retail community, I made a poll about recent IPOs. Chime actually got the least votes. So I know more people would rather see a video on CoreWeave or Nebius, but Chime is trading at really good value for money in the market. And the other ones are, of course, hot AI plays, but you're really paying the premium, and you need to have a deep technical conviction that the stock is worth that multiple. Very few articles on Seeking Alpha as well relative to other IPOs. So it's interesting. I often wonder as well, like if the legacy, a lot of people on the earnings call, right, are made up of sell-side analysts, and of course Chime is disrupting a portion of their business model. I often wonder if that also incurs a little bit of bias in Wall Street. So yeah, the conclusion is that they raised their guidance, right? And their guidance is now between 28 and 29% in revenue growth. Really, really good considering that last year they reported 30.9%. Their customers up 23%, which is in line with the 22.8% they grew them on the previous quarter relative to that same quarter last year. And from the last 3 years, they were growing their customers at a compound annual growth rate of 22%. So that's perfectly in line. I also like the fact that their average revenue per active member grew 12% year on year to $245, which is great, because one thing that I worry about with Chime is that they're this massively expand business, right? And that's great because they got 8.4, or is it 8.6? Let me just check. It's 8 point something million customers, which actually most of them use Chime as their primary account, which is great. But because of the way they're structured, and I will get to that in a minute, I'm a little bit concerned about the expand. So it's great to see 12% year-on-year growth on the expand, the average revenue per active member. However, this was primarily driven by the success of one main branch, which is called MyPay. Now, what MyPay allows you to do is, if you want to get your paycheck early and within 24 hours, you can get a portion of it basically for a $2 fee. So they make money basically off that, doing a slight advance on a portion of your paycheck for a couple of dollars. So that's great, but of course they said that was the primary driver. So it alludes to those expand concerns a little bit. Gross margin was very nice, came in at 87%. And this brings me back to my point about Chime being very good value for money. So before they released their quarterly results, they were forecasting growth, or the analysts were, of about 25%. I don't know what Chime were forecasting internally, but now they're trading at 7.37 times trailing sales, which is about 5 times forward because they're going to grow 30%. If we put a 20% free cash flow margin on that, which they could easily get to once they're optimized, gross margin of 87%. I think sales and marketing as a percentage of revenue is about 35 at the moment, so not particularly high. I am expecting that to remain elevated because they're primarily aggressively going after new customers. You would get 25 times free cash flow on those numbers. And I just think that the market has not really received that much interest on Chime. Now, the real sort of niggle that I have with this thesis, as I said, is they're just not that vertically integrated. They're just not that comprehensive. I mentioned SoFi in my previous video. They're a bank. Mortgages, investments, insurance, anything under the sun, particularly as their members, which they call Henry, high earners not rich yet, expands, their financial lives become more complicated. SoFi can upsell all of those products in one suite. And the problem is like Chime they actually are going after these less than 100,000 a year customers in an annual income, right? And when you take the working age population from that, that's still a couple of 100 million people in the United States. So still many multiples away from the 8 million that they currently have. However, the point is that they, how would I word it best? They are going after these customers because they've been neglected by the legacy banks whose, number one, online platform interface, and number two, just general fees and like punishment for not being a high client is quite harsh on this demographic of the population. So Chime are going after them, but of course then they have to be very customer friendly, and they're doing great on that, like building a really fantastic app. However, they don't want to be sneaky, hidden fee type. So they do offer a lot for their customers for free. And still 69% of their business comes from the interchange fees, which is going down, but they really don't want to like do too much expand, given that they're not a bank, because they can do this like gotcha, and that will damage their brand, because that's what a lot of the legacy banks are doing with their clientele that are basically not earning them a whole load of money from business loans, wealth management services, you know, that ability to be able to lend out large deposits and actually make a huge spread between what they're earning on their investments and what they're paying the customer. Chime do make a little bit of money on that as well, but it's very thin. Obviously, because they're not a bank themselves, they go with their partner banks, and then they take a very small cut of that. So they do have other revenue streams. They also have referrals to third parties, which do other things, and then Chime make money from that for basically being the funnel towards those third parties, so the third parties pay Chime. And this is growing, as I said, like this whole segment makes up 31% of the revenue. Interchange fees makes up 69%. Is that necessarily a bad thing? Not really, considering that Chime said that most of their customers use Chime as their prime account, and because of that, then they're also making money on very much like non-discretionary items, food and gas money, and etc. Right? So Chime will always be taking a cut of that. And I was reading the regulation about the Durban Agreement. The fact that Chime can charge these 1.5% fees is the fact that it partners with smaller banks. The Federal Reserve is likely to keep that regulation in to just basically keep community banks and keep competition within the banking sector. However, it is a risk when Chime is still majority reliant on one revenue source. So it's a bit of a mixed bag with Chime. As I mentioned before, I don't think that this kind of company would have the potential to be a multi-$100 billion company, or if you did, you're basically betting on the management, which I think about the management very favorably. You know, they've had a CTO there from the start as well, so that's really good for just enhancing the customer experience and making sure everything is seamless on the app end. However, they need to actually come up with an expansion strategy of more revenue streams that they can make money outside of their interchange fees, which I said is growing, you know, and the average revenue per member is growing 12%, which is fantastic. So this revenue growth, which I think was actually like 37% in the quarter, came from 23% growth in active members and 12% growth in basically average revenue per active member. So that's really good blend of where that driven came from. 18% payment volume growth, and the actual other segment grew much faster, obviously because now it fell from 72, the interchange fees fell from 72% to 69%. So what I really like about Chime is they're still quite young in what they do. You know, I wouldn't necessarily worry that it doesn't have, at least in its current form, the potential, in my opinion, my humble opinion, right? It's not advice and it's not gospel, to be a multi-$100 billion company. However, the market cap is only at 12 billion. The market doesn't really seem to be interested. And I think that the downside on their existing members, providing that they have this relentless focus to keep them happy and keep serving their needs, keep their members achieving these goals of building credit, helping them to save money, just giving this value add. And a lot of that's for free, which is part of the model, which is part of the concern about how Chime may need to land and not expand. You know, I think that they could do really, really well there. And the downside is not absolutely ridiculous. You know, for a $12 billion company, growing 30%, 5 times forward, the ability to get to 20% FCF margins, because they're at 87% gross. And I haven't checked the gross margin blend, but it may even be higher on the segment which is growing faster. I'm not entirely sure. But if a company can get to 80% gross margin, you know, particularly as they leverage, because Chime do so well on referral, as they grow, that should pull sales and marketing as a percentage of revenue down, particularly when their revenue growth is so high. You know, just sustaining the sales and marketing they've already got is driving meaningful revenue. So that's my 2 cents on the company. Really, really nice little business, putting customers first, bringing, yeah, just like an underserved or unhappy segment of the population. What did they quote? Taking business of the unhappy banked. I'm paraphrasing, but the CEO, Chris Britt, said something along those lines. However, it would not be, you know, if someone said, oh, well, like, would you, you know, if you had like 10 companies to invest in and your money was locked up for like 20 years, you know, I would say under that time frame, Chime has still got a lot to prove in how to evolve their business model in order to potentially reach that market cap of like $100 billion, $200 billion. However, that's not the biggest concern for me because they're only at 12 billion at the moment. And as I said, they probably will expand internationally. I didn't get a lot of elements of that on the call, or I've not read much to suggest that international expansion is imminent. They suggested that the first countries they would look at would be Canada and the United Kingdom. However, I'm sure that that will come, and it looks like they're really just doubling down on the US at the moment. There's not a ridiculous network effect other than the fact that they're building a really good app and then one person can refer another and there's word of mouth. There's not really a massive network effect to having concentrated users in the US, really. But they still have a lot of room to take a massive chunk out of these legacy banks that don't even really want this less than 100K in earned income demographic, because as Chris Britt keeps alluding to, the banks are often generating losses on these lower balanced, lower annual earned income accounts. So interesting business. It's nice to see that there are a few revenue streams, and great to see the interchange fees come down as a percentage of overall revenue. That's my 2 cents. Looking forward to seeing you in the next video.